Good, y'all. It's your boy Frankie T. We're here to talk about ETFs. ETFs. My God. These are so slept on.
What's an ETF, Mike?
So what's an ETF, you're asking? Well, an ETF is an exchange-traded fund. Typically, there are many different ways there are many different ETFs. They're called an exchange-traded fund. You can get this on Robinhood, Webull, Vanguard, any brokerage platform that trades assets, financial assets, and it can give you exposure to, different sectors in the market. Like, for example, it can give you exposure to tech. It can give you exposure to medical. It can give you exposure to restaurants. There's many different sectors. There's many different types of ETFs for many different sectors. Energies, which I'm personally in. So what these do is it allocates a certain amount of investment to many different stocks. So say, for example, the tech sector, you have Apple, Facebook, Apple, Amazon, or let's just say all the tech stocks. So like Apple, Microsoft, Tesla, any of those tech, Google, all that, it'll have a fund of those stocks. So with Vanguard, you have VOO, which is the S&P 500. So it's an ETF that tracks that S&P 500. So you're investing in the 500 most biggest companies in the United States. Or you have VTI, which is the Vanguard, the total stock market ETF. So it gives you allocation to many different assets in the stock market, or the whole stock market, just a piece of everything. So these are really great things to get into if you're not wanting to put your bet on an individual stock, because the great thing about ETFs is that you can take this ETF, you can buy this ETF, say in the tech sector, and not all of the stocks are going to perform. There's always going to be stocks that may not perform that well, and then there'll be stocks that perform well. So everything always balances out. So typically you won't see, the only downside is you won't see crazy gains, but you'll see some good gains, and you also won't see crazy losses, because whereas for individual stocks, if you're invested in individual stocks, you will start to see, if you have, say, $10,000 invested in Apple, for example. If Apple drops, $10 or so, you're gonna see a substantial drop in your portfolio. You know what I mean? Whereas when it comes to investing in the ETF, if you don't want to take the time to look at company statements, the balance sheets, income statements, and the cash flow statements, you can just go straight ahead and buy an ETF that can track, say, the S&P 500, and you make your money off that. Another great thing about these ETFs is that a lot of them, most of them, I believe probably all of them, they pay like a little dividend for you. So a dividend is, basically a fund or even a company, they will pay you a dividend for holding that specific asset, that stock or ETF, whatever it is. Companies like AT&T, or if you buy into REITs, you'll get a lot of dividends for those. Some companies will pay you like a 3% dividend. So if you had like $10,000 on a stock, they'll pay you or $10,000 in a specific company, and they pay a 3% dividend. For all the stocks you have, they'll pay that 3% for you. And that's the great thing about ETFs, is that while you're holding them, whether it goes up or goes down, you will be getting some substantial money every now and then. It depends from ETF to ETF, because some ETFs, for me, for example, I have VOO, and that will pay me most dividends, they'll pay you 4 times a year, because there's 4 quarters in a year. So first quarter, second quarter, third quarter, fourth quarter. So every 3 months. There's some dividends like the S&P Low Volatility Index, SPHD, ticker symbol SPHD. Jeez. that, for example, that will give you, that will pay you a dividend every single month. So if you have a lot of money in there, and I believe they pay about like a 3 or 4% dividend. So if you have money in there, they're gonna pay you that 4% dividend every single month, which is, I mean, you ask me, that's great. So you're seeing your money cash flow over time. So there's something called DRIP, that's Dividend Reinvestment. DRIP is reallocating those dividends when they pay you every month, or they pay you every 3 quarters, or they pay you every year in the dividend. You can take that money, reinvest it in for a little bit more shares, so you keep compounding your shares in a specific ETF or ETFs that you have. So that is the best thing that you want to do. You want to always be reinvesting your dividends. And look guys, buy and hold. If you don't understand anything in this video, buy and hold. Do not sit here and get fearful. I'm down 10%. Oh, I'm down 1%. I'm down 2%. No, you're doing this for the long term. You're doing this for the long term. Like, look, for me, my personal experience. Let me talk to y'all. Let me give y'all some games. So, I personally, I have a Robinhood and I have a Vanguard account. And with these two accounts, I'm able to, on my Vanguard, I have most of the individual stocks. So that's where I will see a lot of the, like I was talking about earlier, when you invest in the individual stocks, you'll see either the rise or the drops. You'll see those substantial rises and drops. You know what I mean? And whereas in the ETFs, I started investing heavily last year, and I'm seeing a lot of good returns off of the ETF side. It's not as much as it is in Robinhood, but I'm seeing those gains and I'm getting those dividends that are accruing, every 3 months, and I'm reinvesting it. And it's great. It's great because you're seeing your money grow. I don't know about you guys, but I love to see my money grow towards the long term. I like to see a steady trend. That's all you just want to see that. You may get some bumps in the road, but that's a perfect time to buy the dip. For all my Dogecoin hodlers, buy the dip. This is the way you want to go about building your wealth now, the easiest way. So how do we start this? So okay, great question. The first thing that we're going to start to do is I want you to pull out your wallet. Yes, pull out your wallet. Let me see your driver's license and ID. Your ID and registration. And I want you to tell me if you are 18 years or older. If it shows there that you are 18 years and older based off your birthday, boom, you are qualified to start investing in the markets. You can go crazy. You can set up your account, deposit money, and start going stupid. So make sure of that first. Make sure you're 18 years and older. And then after that, we're going to start by, the most popular platform I'd say right now is Robinhood when it comes to brokerages to buy stocks and ETFs and whatnot. So you can go onto the Robinhood site, and link is in the description. I can link you guys that for you guys, make it as easy as possible for you guys, and you also get a free stock. Win-win situation. But you can go ahead and click on the link for Robinhood, set up an account, get your free stock. So it's gonna ask you to, you have to have of course your social security number so they can verify you, and then you'll also need documents. I believe it's your driver's license, and then your passport. You don't need, it's either or. So whichever one that you have, you can you just take a picture or something like that and send it to them. And I think it takes maybe like a day or two, and you're able to get verified pretty fast without any issues. As long as everything makes sense and everything's good on Robinhood's end, then you're able to start investing. So once you get to that point, you will get to so once you get to that point, you'll have this platform, Robinhood will show there, and then you'll have that free stock pending or whatever. Again, if you click the link in the description, And then, you can start to look at different stocks and look at different ETFs. So I was walking through my friend the other day. He was asking me how, he can, start investing in life. The same way I'm telling you guys, the same way I'm telling him, and I told him, ETFs, you can go in there, you can look up ETFs or, like the ones I mentioned earlier, VOO, VTI, you have VYM, that invest in real estate. So you get a lot of those good dividends from that. I have some shares in that as well. Not a financial advisor. I'm just telling you guys what I'm doing and how I've seen my wealth grow over the past 2 to 3 years. Because look, I started doing this when I was, honestly, I don't know. I think I was 17. I don't know. I feel like I started investing because I was in college. I was 17, and that's when I would be in class and I would invest. I would wake up to my math class at 7 a.m. and I would start investing. I'd go on to my Robinhood app and I would deposit $35 every week, I think, because I used to get paid weekly because I worked at Fry's during the time. It's crazy because my math teacher told me, when he saw me on Robinhood, he was like, I don't know why you're investing. You're not going to make money doing that. You don't make money investing. You're wasting your time. And that, honestly, that has fueled me to really, ever since hearing that from my college math teacher, it's wow, he really just said that to me, in front of the class, but I mean, I'm somebody that doesn't really, feed into all that hype, but, so, that's a whole other story for another day. I know I kind of got off topic, but, you can, get into these ETFs, you put in your money. I kind of lost where I was after that story, but you can put in those. You can deposit that money. You're gonna link your bank account because Robinhood will ask you, what bank account would you like to link. You can link your, debit card and start investing monthly, please, guys. So if you can invest monthly, you can make monthly or weekly deposits into your account, so maybe $100, $200, maybe $300 a week. If you have that capital to do that, please go ahead and do that. It's so important that you have your money in different avenues and things that can make you, more, because with inflation going crazy and this whole thing, whole market that with the free stimulus checks and everything, it's making people poor. It's making the wealth gap bigger, but that's a whole other topic for a different day. So you want to have yourself in these asset classes because when inflation goes up, these things are going to go up with it. These things are going to get more expensive. Housing. You guys see the housing market. You see how wild things are. I'm over here trying to get a house and I can't even get anything. So, but yeah, put in, $100, $200 if you can. Try to budget and allocate money to make these monthly investments. You need to have that dry powder, that money to buy these assets. If you can do it every month, because there'll be times where the stock market may drop, and you may have that. You have that $200 coming in on the first. Boom, you're getting things at a cheaper price. You're building that share. You're building your share because the more shares you have, the more dividends you'll be getting. So as you're getting more of these dividends, you have drip on dividend reinvestment, reinvest it into these companies. You're gonna see a lot of growth. You're gonna see, over time. And I'm not saying that you're gonna make money in the short term or in the long term. Anything can happen. Who knows what may happen 10, 20, 30 years from now. But based off in the past, the track record, the stock market always trends up, which is what the next thing I was going to get into. When it's these ETFs, you can go on to Vanguard.com. You can even set up an account there too as well. That's another great place. I have money in Vanguard as well. You can go on to Vanguard.com and you can look at these asset classes that I mentioned, so like VOO or VTI or VYM. There's so many dividends. I can keep going on with, these indexes, SPY. There's a lot. And And you can go on Vanguard.com and you can see how it's performed over the years. You know, you have the $10,000. You know, started at say January of 2010 or 2011, and it's here now. And then, you know, it'll show. I'll probably have to show something here about it, like the chart and stuff like that. Then you'll have as well, you know, for VYM, how many dividends, all of them, if they pay any dividends, when do they pay the dividends, where the expiring dividend date, you know, they'll have all that stuff. They'll have what what stocks are being invested into these funds. So for like the S&P, for example, you know, its top holding will have Tesla, it will have Microsoft, it will have, I believe, like Netflix or something in there, and it'll tell you what exactly this money is is allocating to. Now, I'm going to tell you guys the flip side. Warning. It's always a warning. I want to make sure that you guys are all fully, you know, understanding of, you know, like what you're getting into and what you're trying to do. So with these ETFs, do not look at the dividend and say, oh, this company's paying a really high dividend, or this ETF is paying a really high dividend, so I'm just gonna go take out my 10K and just throw it into this, because I'm going to be getting all these dividends. You don't want to do that, because a lot of times, sometimes, you know, the stock of a company or an ETF, you know, I'm kind of using these terms interchangeably because ETFs are not the only things that pay dividends, but if an ETF or stock is dropping, sometimes it will kind of make this blur, and it's like a cloud that, like, it will say that we're paying a 20% dividend, but the stock has been dropping over the years or over the weeks or months or whatever, and it just hasn't adjusted. So a stock is $5 and it's paying I don't know, a 10-cent dividend. It's going to look like it's paying, what is that? What's that percentage? I don't have my calculator, but $5 to 10 cents, I think that's like what, I don't know how much percent, but let's just say the stock's $5, it's paying a $1 dividend. You know, that's like what, 10% or something. My math is trash, but it's going to look like that's a lot. Like, wow, I'm getting 10% on my money, but the stock is dropping and they haven't adjusted those dividends. So, you know, you're looking at it from the past, because eventually it's going to change because the company's financials are bad and whatnot. You know, so you want to avoid, you know, getting into companies just because they have a great dividend. You know, and again, this goes into, if you don't really want to look at these financial statements, you don't want to look at all this stuff, you can just look at the best performing, you know, ETFs with the best stocks. You know, I mean, you see Apple every day, you see Netflix, you probably Netflix and chill every day. You know, you're gonna have all that stuff. You know, you know of all these stuff. You know how big these companies are. Those blue chip companies that they call them, blue chip stocks, Google, Amazon, Apple, all that. Those are what will, you know, get you through the long run, even in the worst times, when things get rough. You know, those things tend to still stay up because of just how much in demand they are in the market. I mean, you Google everything. You know, we don't even say look it up on the internet. We say Google it. Like, it's a whole different shift. So, getting into things like those will kind of, you know, if you really don't want to do your research, you can just get into the S&P 500 and call it a day. You know, I'm just a random guy on YouTube, so don't take my advice for it. I would recommend you do your research before getting into all these stuff. But again, another thing is the fees. So you also, when you go to Vanguard.com and you look through, you know, the specific asset that you're looking at, the ETF or stock, whichever one you plan on getting into, it will have, you know, the expense ratio. So the expense ratio is what you're paying yearly to continue holding your money in that specific stock. At least on Vanguard, that's the case. So because I have money on Vanguard, so assuming that you guys, and I'll link Vanguard's account set up in the description below as well. So if you guys wanted to do do that, you can do that. But in Vanguard, you will see the expense ratio, and ETFs, the expense ratios are very, very low. That's the great thing about them. It's very, very low. So if you're investing in ETF, you're paying like 0.03% or 0.05% on ETFs and stuff like the S&P 500. Like that's, that is amazing. Like, you're paying 0.03%, on, that's like what, 3 cents or something. You can off $100. No, not 3 cents. I don't know. I'll have to do the math. If you have $1,000, how much that would be? 0.03 times 1,000. My math is trash. I'm sorry. I dropped out of college, so. But you do the math. It's a very low number. It's very, very minimal. It's very low, so you won't have to really worry about paying these like extravagant fees like it was back in the day. And it's great. It's great. So that's my take on this and my advice on this. Do your research and figure out what it is that you really want to do. But the easiest way, if you do not have any stocks, if you don't have any bonds, you don't have nothing, you don't have any kind of assets, save up that money, or look at what you're spending, because there's always some BS that you're spending money on, and you can cut those things out. If you're going out to eat like 10 times a month or something, you'll probably be spending well over $100 from that, depending on where you're eating at. So you can take that money and say, hey, you know what? Let me put this in the stock market, and I can go buy some stocks. In Robinhood, you don't need the exact amount to invest the money. If you wanted to invest $10 a month on VOO, like I don't care if it's $10, like you're doing something, but you get out what you put in. So if you put in very little, you're gonna get very little. If you put in a lot, you're going to get a lot. So it's very good to just make sure that you're always allocating money for investments, because you want your money to work for you. It's not, the best thing is to wake up in the morning and see that your money went up $3,000-$4,000. It's a great thing, if you trade and stuff like that. But it's another great thing, to see if it's going up maybe from 100 to 150. Like that's $50 that you didn't have. It's those little things that kind of build that confidence and continue to put more money in, put more money in. That's how people become millionaires, The easiest way to become a millionaire. And anybody can do this. If you have that money, you can definitely go and apply it and just hunker down and just do it. So, with that being said, those links are going to be in the description. Vanguard, Robinhood. Get your free stock on Robinhood. If you haven't set up an account, go down there. If you already set up an account, you're already ready to invest, or you're already investing. Props to you, salute to you. And pay more attention to those things. I have my past video on with Joe Biden. Joe Biden's the EV video. So if you haven't checked out that EV video, it's gonna be somewhere around up here somewhere. You can go and take a look and watch that. That can give you maybe some good insight as to how things are going to be moving in the future, and where the United States, or even I'd say even the world, is trying to move towards too. So with that being said, if you learned something from this, I would love, this is a new channel here. We are very new here, and I really like doing this. This is really cool. If you guys liked or learned something, got a new perspective, or learned some information, or got some value out of this video, please like, share, comment, subscribe. Let me know if there's something you probably don't like, or something you have another opinion. Throw that down in the comments. I would love to hear it, and we can chop it up and talk it up. So other than that, I hope you guys have a wonderful day, and as I always say, you gotta be clear, cut, and concise. Peace.
2 times.
Hey, T-Mills, hey, I need that guap in my hand. 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 I need that guap in my hand.